Good morning, good afternoon, everyone, and welcome to our first video program of our new series. My name is Greg Mencken. I'm the Executive Director of the Adam Smith Society. I'd like to welcome everyone for joining us today for what will be a very exciting new virtual programming series from the Adam Smith Society. Before we begin, I'd first want to wish all of you safety and well-being as we all adapt to the new reality that we are currently facing. While the Adam Smith Society has canceled and postponed many of our offline events, that doesn't mean we are postponing our important mission to promote the discussion and debate around the benefits of free enterprise. So while many of you work from home, learn from home, we wanted to invite you to take a Smith Sock break each week for lively discussion around a variety of topics, including the broad implications of coronavirus. If you're not already a member of SmithSoc and would like to learn more, please visit us at adamsmithsociety.com. To kick things off today with a discussion of the pandemic's implications for cities and our economy, we are thrilled to welcome a leading expert in urban economics and finance, Nicole Gelinas. She's a senior fellow at the Manhattan Institute, a columnist for the New York Post, and contributing editor to City Journal. You can follow Nicole on Twitter at Nicole Gelinas. Nicole will give a brief 15 to 20-minute talk, followed by audience Q&A. Please note this video conference is being recorded. Just a quick word on how to ask questions. You may ask questions in the question box in your GoToWebinar controls or by raising your hand to ask your question by audio to the entire group. Question box questions will be read aloud to the group by my colleague, Dean Ball. To ask your question personally by audio, click the Raise Your Hand button, which is on your main GoToWebinar control just below your mute button. It looks like a hand with arrows indicating if your hand is up or down. If selected, you will connect by audio into the video conference. When we invite you to ask your question, confirm that your audio control is green, meaning that you are unmuted. Phones will require your audio pin to ask a question out loud. Otherwise, please use the question box, which you can reveal by clicking the orange left arrow on your GoToWebinar controls. So you can ask a question in the question box or just raise your hand. Please keep your questions and comments brief and state your name and chapter affiliation to ask a question. We'll get to as many questions as possible. And you don't have to wait until the end of Nicole's remarks. You can raise your hand or ask a question at any time. When she concludes her briefing, we will get to the Q&A. So with that, I'd like to welcome Nicole. Thanks so much.
Thank you, Greg, and good morning, good afternoon, good evening to everyone. Thank you for taking some time out of what I'm sure has been a chaotic week for everyone to think about how all of this is going to impact us economically and in urban areas. Cities are the global economy, and that statement is not to denigrate anyone who doesn't live in a city, work in a city, doesn't like cities. But as famed urbanist Jane Jacobs said in her second most famous book, The Economy of Cities, farmers sell their products in cities, artisans sell their crafts and works in cities, businesses that have nothing to do with cities are financed in cities. So in short, the city matters a lot to whatever happens outside of the city and vice versa. As Jane Jacobs said in her most famous book, Death and Life, the ballet of the good city sidewalk never repeats itself from place to place. It's always replete with new improvisations. So here are two pictures that I took in New York City over the past 2 months. The left one shows a very healthy pre-coronavirus city, at least pre-coronavirus in that the spread had not been confirmed in the city. We certainly don't know whether there were cases in the city by that point. So the left-hand picture is on the Staten Island ferry. This was just 2 days after the crackdown on Chinese nationals coming into the US and New York City. But for the most part, global movement was still fluid. There were still some Chinese national students and tourists and workers in New York City. So you see everyone on the Staten Island boat. People are not afraid to be standing near strangers. They're relaxed, happy, taking pictures on a nice winter day, a healthy looking crowd. Then a month later, you see just over this past weekend, the line at the Columbus Circle office complex, a line of people waiting to get into the Whole Foods, the supermarket in the basement of this office retail complex. This is not a natural urban sidewalk ballet. These are people who are scared, who are alone, who are in what could be considered a crowd, but they don't want to stand very close to one another. They're trying, although not really succeeding, in standing six feet apart. They really don't want to be out there on that sidewalk. They want to get out of there, but they are improvising. I mean, Jane Jacobs was not wrong. They are improvising a way to try to get into the store and get their food safely. And as you can see, a lot of them wearing masks out of doors. But just if someone didn't read any newspapers, didn't know anything about coronavirus, just looking at these two scenes, you could see a big difference in the urban landscape. Another pictorial of the changes that we've seen over the past few weeks. Jane Jacobs liked to have her eyes on the street. The public health response to COVID-19 has thrust in very unprecedented experiments upon urban economies. And I took all of these pictures of the storefronts up and down Madison Avenue in the middle of Manhattan on Monday, I think. So just in 30 blocks on one side of Madison Avenue, there are more than 100 small businesses, small restaurants that have had to shut down, both because of the state order, but also because even before the state order, customers were fearful they were staying away from these stores. So a sort of tableau of each of the little signs that each store owner put up in his or her storefront saying, we're going to be closed for the foreseeable future. So it's kind of a collage quilt of an unfolding private sector economic disaster, that it's all of these little stores, restaurants, of course, chain stores, chain restaurants too, that make up much of New York's private sector ecosystem. And that ecosystem for the moment and for the foreseeable future is effectively shut down. And of course, I know many of you are listening from all over the world, from both cities and not in cities. Though New York is currently the US epicenter of the coronavirus crisis, the phenomenon has forced lockdowns in hundreds of US as well as global cities, from Anchorage to Boston to New Orleans to San Francisco to Birmingham, Alabama. People are under various orders to stay home, and restaurants and stores are shuttered. So these shutdowns of much of the global economy and the local economy obviously have a dramatic impact on local private sector jobs. And again, if you think about New York City, but this certainly applies to other global cities and much smaller cities, the private sector in a city like New York is a tradable service sector. Much of it is a tradable tourist sector. Our tourism sector is a global export. It is a big part of New York City's global trade. Our financial sector is a global export. It's another big part of New York's global trade, or US global trade. Same thing with many professional business services jobs. Even retail and restaurants in a city like New York, London, Tokyo are in large part an export, because the product is being sold to tourists who are foreign nationals. And that is true even in smaller American cities. New Orleans depends in large part on global tourism as well. So when we shut down a city, we shut down a big part of the global economy, but it also has a big impact on local people who may never think about the global economy. So the private sector, and in large part the small business private sector, is the backbone of New York City's economy. New York started out in 2020 with 4.1 million private sector jobs. That was a record for the city. More than 10% of those jobs, close to 500,000, were in leisure and hospitality. This is everything from Broadway dancers to hotel housekeepers to Airbnb hosts. to many jobs in the opera, philharmonic, tens of thousands of jobs in entertainment alone, much of the rest in hospitality, another 350,000 close to jobs in retail trade, and then close to 1 million jobs in professional business services, which includes the tech sector, 500,000 jobs in finance, 50,000 jobs in building construction. This is obviously a big portion of New York's economy, and these jobs are under acute threat right now. It would not be surprising if we lost more than half of our close to 1 million jobs in leisure, hospitality, and retail trade. So you would be looking at a loss of 500,000 jobs there. But then if you look beyond the workers who interact directly with the public, those workers are the people who are unfortunately the first to be hit by this, but they won't be the last. The financial sector has never gone through a recession without having tens of thousands of layoffs. If you look at the tech sector, companies such as WeWork and Uber were already struggling before this coronavirus hits. It is unlikely that they will survive this unscathed either. So all in all, it would not be an insane argument to say New York City could lose 1 million jobs. Hopefully it will be less than that, but that is the reality that we're looking at, is losing a quarter of our private sector job space, at least for a few weeks or months. And just to give you an idea of what that scale means, after the September 11th, 2001 attacks and after the 2008 financial crisis, New York lost fewer than 200,000 jobs in each of those downturns. So losing even anything like 500,000 jobs would just be an unprecedented event for the city. And again, the same thing happening around the world. London, Milan, Paris, and in the US, many cities that don't have New York's economic and fiscal resources are suffering the same types of declines. Now, what kind of jobs are protected, at least at the moment? You've got another over 1 million jobs in healthcare and education. But these jobs, although very, very valuable, obviously particularly valuable right now with so many healthcare people on the front lines and teachers trying to teach students at home now that schools are closed, these jobs are critical, but they depend on the health of the private sector economy. They are not by themselves productive parts of the private sector economy. They depend on tax revenue and on employer-financed health insurance in the case of the US. So, of course, catastrophic private sector job losses could and likely will decimate the local tax base. New York, like many cities, has a diverse tax structure. Biggest source of tax revenue is the property tax. A little less than half of the $66 billion in tax revenues that the city expected to take in this year would have been from property taxes. Property taxes are generally a very stable source of revenue. They don't really fall very much in a downturn, even after 2008. But this time, as they say, really could be different, because with so many commercial retail tenants, commercial restaurant tenants, and even office tenants likely looking for rent deferment or cancellation for the months of March, April, and maybe even May, you will see property owners looking for an assessed revaluation of that property. The other tax revenues are much more sensitive to economic activity. Without private sector companies doing their trade out on the street, the city doesn't take in income tax revenue, could potentially lose a good half of this projected income tax revenue. Same thing with sales tax revenue. Both personal income and sales are dependent on economic activity, much of which occurs at the street level. Without that, the city just does not have a healthy tax base. And so, again, even if you didn't know anything about coronavirus and you weren't walking around on the streets of the city, the municipal bond market is sending a useful free market signal that something is very wrong. And for some of our global students who may not be familiar with municipal bonds, Municipal bonds is the way in which states and local governments borrow money for their long-term capital projects. And it's generally considered not risk-free, but very low risk. It is not common for municipalities to default on their debt obligations, and no U.S. state in modern history has defaulted on its debt obligations. And so you can see here, I made this chart last night, so it doesn't include today's activity, but you had steady and falling municipal bond yields over the past year, and indicating again, investors didn't see a lot of risk here. And then suddenly these bond yields close to quadrupled in just the course of a week. You have basically a straight line up in municipal bond yields starting in the second week of March and continuing through earlier this week. Then again, the yields came down a little bit because investors think that the federal rescue package will help cities and states to ameliorate some of this crisis. But an important signal from investors that something very bad has happened in this market. What are the two things that investors are saying? The first thing is that they're saying is that they just want cash. Investors don't want to hold any type of security, even a simple low-risk municipal bond. They just want treasury securities. And of course, that's why the Federal Reserve has launched these extraordinary programs across the economy. The second thing is that they are signaling there is a higher risk of default here. And that's not a surprise that if cities across the country, including some of the richest cities in the country, are seeing this decimation of their tax base, at some point, the longer this goes on, they will have to think, do we maintain basic services or do we defer some of these bond obligations to the future? So what does the immediate future for cities look like? It is highly unlikely that even the most ambitious federal rescue package can entirely replace the lost private sector income that we're seeing. And you could do this equation on the national level. I mean, basically just X out a quarter of GDP. What would it look like for the federal government to try to replace that? You would be looking at a $5 trillion rescue package, which is more than twice as much as what Congress is contemplating right now. But even on the New York City level, New York's gross city product every year is about $1 trillion. It is well within the realm of reason that we could lose 10% of that. That would be $100 billion just taken right out of the private sector economy. Even conceivable that we could lose well more than 10%. So broken down, how does the $2 trillion federal aid package that Congress is contemplating, how much of private sector activity would that rescue in New York? The package the Senate voted on, roughly $40 billion in benefits would go to New York, some of it unemployment benefits, some of it the checks to individuals, some of it direct aid to local governments and the mass transit system. But even this package of $40 billion, this replaces just a fraction of the $100 billion or more in gross city product that we will make up for. So the government certainly cannot make up for lost private sector activity on a sustained basis. Can it and should it do it right now during these acute closures? Yes, but it is the private sector that powers New York's economy. And you see some skepticism, again, that this rescue package will do enough to help cities in the short term, where for a brief time, you had the municipal yield on the 1-year bond actually just as high as the yield on the 10-year bond, indicating that investors think some of these obligations will be deferred to the future. So what is the purpose of the federal aid package here? It's to make sure that small businesses, even larger businesses, self-employed entrepreneurs, and employees across the restaurant, retail, leisure, entertainment, and other sectors of the economy, that they are not so devastated by what should be a temporary crisis that they cannot get up and running again quickly. In other words, if we get the all clear 3 weeks from now, a month from now, who knows when it will be, that we can get up and go about our business again. You want these businesses to be able to open up quickly, hire back their employees quickly, restart their own businesses quickly again. You don't want them to be in such a financially stressed situation that they can't get up and running again fast. So the purpose of federal rescue is make sure that when the economy is ready to open again, all of these private sector actors in the economy are ready to go. The goals here, the cities have to rebuild their private sector tax bases quickly. They cannot do that if they have to cut back on basic services like policing or basic infrastructure like running the subway. So that is why you need the bridge of federal aid, because if the city were to have to respond by saying, well, we've got to just lay off half the police force, people then may not want to come back. It doesn't help that many cities and states faced pre-existing financial conditions that weren't so great. Even wealthier cities like New York had unfunded pension and healthcare liabilities for their public sector workforces and hadn't really invested enough or wisely enough in their public infrastructure. So the crisis exacerbates those pre-existing conditions, just as it worsens the pre-existing conditions for companies like WeWork and Uber. But withholding the federal aid could easily turn the recession into a depression, making it much harder for cities and thus the global economy to recover. And here you see a picture of the empty Metropolitan Museum of Art over the weekend. So those are the specific economies of cities shown through the example, of course, of New York. What are some of the longer term uncertainties for the economy of cities, to use the title of Jacob's book again? Cities in the long term are not going to die. We have 7.8 billion people on the planet. If there is a way to facilitate human interactions among these people outside of cities, I'm happy to hear it, but we haven't devised that way yet. Everything that we're doing on our webcams and ordering food in are largely temporary measures. Most people don't seem to enjoy doing business like that, at least not all the time. They do want to get back and out and about and be with other people. But the outlook time-wise on that depends on when do we get a vaccine, when will our global tourists and our investment property purchasers come back. That's not only a legal issue with the tourism, when will governments reopen their borders, but also a comfort level. Will older Chinese people, for example, will they feel comfortable taking a long plane ride? Will people feel comfortable going back to Italy? These are more psychological questions than just issues for the State Department and the CDC to determine. Will companies cut back on their office space demands, thus affecting the property market? Even if people work at home just once a week, that really impacts your need for office space if people can share offices or share workspace. Will people be leery of the mass transit system and not want to ride on the subways? That really affects the economy of a city like London, Tokyo, New York, Boston. But all of these uncertainties are not density for all, or are not destiny. For all of modern history, the density of urban areas and wealth have gone together. So in sum, it's not a really positive picture at the moment, but long term, we've heard about the demise of cities for centuries, even millennia, and this is highly unlikely to be the demise of cities. The cities are the nexus for all of this human economic, social, and psychological behavior. This is not an unfixable problem. And here you see Grand Central empty and Grand Central the way it should look and the way that it likely will look. It's a matter of when, and we don't know when, but it's not a matter of if. So thank you all for listening, and I'm very happy to take any questions, comments, various points of view.
Thank you so much, Nicole. Yes, we would like to now open it up to audience Q&A. As a reminder, you can ask a question through the question box or by raising your hand. And since I'm here, I might as well start things off. So again, thank you so much, Nicole. You talked about the government's role in helping us get out of this mess. And it seems to me by what you were saying, it was along the lines of, well, we need government to help the private sector get back on its feet. But then government needs to let free enterprise do what free enterprise does best. So can you just kind of talk a little bit more about that and the role of the private sector in emerging from this economic trouble that we're in?
Sure, I think that's a good question. And the private economy of New York and many cities, all cities really, it works pretty well by itself most of the time. You know, I don't need a lot of government interference to go to a restaurant and enjoy a nice meal, or to go see a Broadway play, or to go to the museum. Of course, government has a role in maintaining basic order, policing, basic health and safety standards. But for the most part, the private sector of New York can go about its business and be virtually ignored by the government, except for when local, state, and federal government want to come in and take their tax burden from all of these levels of businesses. So this is a temporary rescue. I mean, the federal government's role is to provide a lot of cash aid here until the private sector economy can reopen. I mean, if anything, this whole crisis shows that you just cannot replace intricate private sector activity. There's just really nothing out there that can replace it.
Okay, we have a question from Radin Simangunsong from Colorado, UC Boulder. How, Nicole, do you compare current impacts of COVID with SARS and the swine flu in the past?
Well, that's another excellent question. There's a group called Tourism Economics that did a stress test on what might happen to global cities from the tourism impact. And they did this after the Chinese border was closed. So this was very, very late January, first week in March. And they said that during the SARS public health crisis, tourism to the US fell, or Chinese tourism to the US fell by 20 to 30%, depending on what city. So it did have a big impact at the time, but that was just one country, obviously an important one, but we didn't see all global borders essentially close. And it did, I mean, I'm not a scientist, but it seems that SARS did not spread as readily and as easily as COVID-19 did. So it's certainly the same type of impact, but just on a much, much greater scale. Same with the swine flu might have been a little bit different, and I don't want to claim to have any kind of medical expertise that I don't have, but I think we can just look at the government responses in the massive closing of the borders over just the course of 3 weeks, starting with China, moving on to other countries in the Asian part of the world, and then moving on to Europe in just an overnight decree with borders between Europe and the US closed, and then going on to Canada and Mexico. Certainly never something that we've seen in modern history.
Next up, we have a question from John Sampugnaro of our Austin chapter. How would you expect this crisis to affect infrastructure development, municipal operations, and land use?
Well, I think the biggest long-term risk, once we hopefully get out of this acute public health crisis, is that cities around the world, because they have constrained budgets, not just for the next 6 months, but potentially for the next few years as they recover from this, if they cut back on their basic infrastructure budgets. So if a city like New York says, well, we have to delay the plan to modernize the subway signals, or we can't continue to build the Second Avenue subway, that would not be a very good signal to the private sector that we are going to recover from this thing. So I think we should look at capital budgets and say, what are the most important infrastructure projects that we need to do? Are there some things that could wait a couple of more years? If so, then sure. But for critical public transportation, public safety infrastructure, I think we don't want to cut back on those budgets, which means, unfortunately, looking at a lot of the problems that cities and states had before this crisis hit. Can we afford the old-fashioned sort of pensions where public employees work for 22 years and then are retired more than 22 years? Can we afford this very bifurcated healthcare system where public employees get essentially free, very high quality healthcare that is paid for by the local governments? And of course, the private sector taxpayer not only has to pay for that, but also pay for very expensive healthcare on the other side of the market. So a lot of markets or a lot of aspects of municipal budgeting, when the boom was ongoing, cities could kind of skate through and avoid making some of these decisions. But I think it will be much, much harder for them to do that over the next few years.
Our next question comes from Neil Chowdhury of our New York City chapter. Nicole, do you think the situation has brought to the fore the dangers of globalization? And do you think that the new normal might be a retreat from globalization, the kind that we've experienced over recent decades?
I think it will be a new normal for quite a while, in both on the global government and regulatory level, and also just on the level of people's personal comfort. You see some of these traumatic images of people on cruise ships. So will people want to get back on a cruise ship, especially if they're older and maybe more vulnerable in the long, and who knows how long that will last. I mean, people have proven very resilient. They went back up in tall buildings after the 9/11 attacks fairly quickly. So who knows? But I think that in the long term, it will be very hard to avoid globalization. I mean, we've always known that globalization comes with problems, and we haven't always dealt with those problems very well, but it's not going to be sustainable just to completely close off global borders and global supply chains. And it may make us even less financially able to deal with a crisis like this if one were to occur again. I mean, you can close off borders, but you certainly can't or would want to get rid of the existing urban density that we have. And so without a hermetically sealed economy, something like this will still find its way across the globe, maybe at a slower pace than has happened, but there's just no way you can seal yourself off from the problems of other parts of the world and vice versa.
Our next question comes from Tristan Wimmer from our University of Pittsburgh chapter. What are the short-term and long-term effects of this upcoming recession on U.S. real estate? Will it be on par with the 2008 recession?
Yes, it will be on par with the 2008 recession in terms of scale of wealth lost, but it will be distributed differently. For the average single-family home that is not in an expensive urban center, this was the part of the market that was hit the hardest, starting in 2007 and then going through, in some markets is still barely recovered. If Congress is successful in sending cash replacement income to workers while they are out of work, then we can avoid massive defaults on single family mortgages and hopefully big write-downs in the value of those homes. I think that the impact here will be in the global cities that largely avoided real estate valuation drop-offs after 2008. New York, London, Hong Kong, all places that barely saw a blip after 2008 and have the valuations increased markedly until around 2016, 2017, then started to level off and fall, because this is more of an export market. Will a Middle Eastern or a Russian or Latin American high net worth individual, will he or she see putting money in a Manhattan condominium as such a safe haven that it might have seemed 10 years ago? That is certainly debatable right now. And we came into this crisis with an existing oversupply of residential housing that was built for the global investment market. As of a couple months ago, a quarter of the new condos built in New York City were unsold. I know London has had the same problems with the Battersea development, other developments built to sell into the global investment market. So this will certainly make those problems much, much more intense. And then, of course, there's the office market side. The WeWork frailty was already likely to affect the demand for global city office space as large companies, mid-sized companies rethink, do we need to have all of this central city office space? I think there will certainly be a lot of uncertainty in that market for a couple of years, at least.
Next question will come from Ben Cox from our Boston University chapter. Ben asks about high tax states and how they're going to deal with this. Prior to this crisis, there was already large migration from high tax states like New York to lower tax states, many of which are in the South. Do you think that this will hasten this shift and create a double whammy effect where the big expensive cities pay the majority of the bill and then are left with a depleted tax base to recover it?
Yes, I think that that is a big risk, and it is something that city officials have to keep in mind as they look at their budgets for the next couple of years. There's already a progressive movement in New York State, New York City, to say we have to solve this by raising taxes on the rich. But the wealthier people in New York already paying close to a 13% local and state tax burden. When you consider federal taxes, it's pushing you close to or above, in some cases, 50% of personal income. And so this, to the extent that people were already thinking after the federal tax law was signed in 2017, capping their state and local tax deductions, it is better for me to spend most of the year in Florida, Arizona, South Carolina. I think it's fair to say that this will hasten this process, that at the moment, the risks of being in the city, if you do not have to, outweigh some of those benefits. And it's the city's job to make sure, maintain core public services, maintain the public infrastructure, don't go giving people another reason to want to leave in a very tumultuous time.
And our last question is going to come from Gregory McNiff from our New York City professional chapter. Given the impact to financial markets of the recent crisis, how significantly do you expect endowments and nonprofits to be impacted, both in terms of less assets from which to draw income and potentially less donations?
Yeah, and I'm glad that Gregory asked that, because that's a big issue that I did not mention. I mean, I had the picture of the empty museum in there, but the museum sector alone in New York employs 11,000 people. This could have impacted the local economies in two ways. One, museums, opera houses, Broadway, although Broadway is a little different because it's supposed to run on it's not for profit, but it's supposed to run on a, well, actually, I guess most of it is for profit. So the operating expenses are supposed to pay for themselves. But museums, Philharmonic, opera, many large cultural organizations, and much, much smaller ones, they've lost a good part of their season. I mean, they've all had to cancel the very lucrative spring tourist season and the spring fundraising season. Even the start of next year's season is looking a little bit iffy. They've had to lay off a lot of people. A lot of gig musicians are out of work right now. So getting these cultural institutions up and running is part of providing an important amenity that keeps wealthier people in the city. But on the other side, at a time when organizations across the nonprofit spectrum are going to be looking for the philanthropic community and saying, can you do more? These large brand name organizations, they're going to be exerting such a pull for a lot of this money that it may be very, very difficult for the smaller organizations to kind of gain any attention. So I think that's very important, a very important role for the philanthropic community to play, because it will be a very difficult recovery.
Thank you very much, Nicole. We really appreciate it. And thank you, everyone, for joining us today. Nicole, so everyone can see the information, could I just ask you to please go to the final slide in the presentation? I think there might be one more there. Thank you. So thanks so much, everyone, for joining us today. Tune in again next week, Thursday, April 2nd, same time, 1 p.m. Eastern, when we will hear from energy expert Mark Mills on the new oil supply wars and the future of oil and alternatives. Check out our full upcoming lineup on the website here you see on your screen. I want to wish everyone a great day, continued health and well-being. Thank you, everyone. Thank you, Nicole.
Thank you, Greg. Thank you, Dean.